Welcome to Module 3 of Week 4. We're going to talk about some gifting techniques, again, expanding on what gifting is and how it's done. About Module 2 spent a lot of time on trust, and we're going to look at some more. There's interfamily transfers involving a sale. Um, we talked earlier about a gifting to family members, where you gifted it, and the example I gave was the tractor that from my farm and to my son, and this is now getting into sales to family members, which is very similar in many respects, although the rules are all different. Sale to family member, it does keep it in the family, and it avoids sales mission and expenses, sales commissions, it should say, and expenses. If sold at fair market value and receive payment in full, there is no gift. The IRS puts the burden on the taxpayer to prove the facts. And again, the IRS will take on the responsibility if you're not related parties to claim that it was a gift, not sale. But if it's a related party, and that's determined very broadly, the definition of what a related party is means that the taxpayer has to show it was not a gift involved. Remember, gift tax is a lot higher than income tax. Now, in the case where the seller is liable for all transaction taxes if it's a gift, and the buyer disposed of the assets responsible for gift or income taxes associated with when they get rid of it. A bargain sale is a term used for assets sold for less than its fair market value and will be considered a gift for the difference between the amount paid and the fair market value. Now that is not uncommon I have a car that's worth $30,000. My son's having a tough time, so I sell it them to $20,000. That would be an example of a bargain sale. I it could be a gift to a church or charity where it's worth $80,000 and I charge $20,000 to the charity because I need some cash, but I want to make a gift. Again, a bargain sale. The difference between the amount paid and the fair market value becomes the value of the gift and the bargain sale. Installment sales. This is really an income tax issue, but I do cover it here because later on we talk about self-canceling installment notes. In which installment note, again, or installment sale is a purchase that was not fully paid in the year of sale. I'll give you a very simple example. Let's say you buy something, you make a payment in December, and you make a payment in January. That's an installment sale. It is not the same thing as we're talking about when you buy something on an installment sale at Macy's or at Target. This is a unique set of items that can fall under a bargain sale, and again, it's basically from your income tax course, but I wanted to refresh your memory on it. Um, the seller may recognize gain from the sale over the period of which the payments are made rather than the year of sale, and that can be a big advantage if you have something which will throw you into a higher tax bracket if you did it all in 1 year. By spreading over several years, it keeps you in the lower tax brackets, and that's probably the biggest advantage of it from the seller standpoint. Of course, the buyer standpoint is they don't have to pay it all at once. And the proceeds under an installment sale consist of a return of your basis, your gain, and your interest, again, which are covered on your income tax course, but we're using for the self-canceling installment note, which we're talking about next. It's a self-canceling installment note is similar to an installment note, however, provisions of the agreement limit the purchaser's obligation to pay if some event occurs. And let me just, rather than going through the chart here, tell you how it would be used. We have a situation where a family member has got a lot of money or assets that they want to get out of their estate for estate tax purposes, and so they would, at the same time, would like to be able to guarantee themselves a cash flow. So what they do is they have an installment sale with a family member, so the family member gets the benefit of it rather than, say, the bank or a third party. And when we deal with related parties, we must show there's a business transaction. So that might be a sale of an apartment house or sale of a tractor or something, again, business related. And the payments are made till date of death, or they're paid off whichever occurs first. So let's say dad is 68 years old and he's in terrible health. He's got cancer, and so he arranges an installment sale on a business asset that then we follow the IRS rates of interest rates were charged. We make sure it's a fair market transaction as far as the fair market value of the asset. And when the father dies in, say, a year or two, the notes stop paying because, again, the way the rates were set up, according with the IRS rules, and we met the requirements, it gets set out of the estate. Very useful tool, and especially useful if we need some kind of guarantee that the children will be making the payments, or the beneficiary is going to make the payments to you, that you need the payments. And certainly people with medical conditions like cancer need to get the money in many cases, so they have to have some guarantee that it'll be paid. Similar to is a private annuity, and I like to say it's the same as a public annuity. Instead of giving your money to John Hancock, you're giving it to your son or grandson, and it's a private party. And the key thing for this is that you don't have any security, just like you don't get a security from John Hancock, nor would you get it from your son or grandson. And it's you have to follow the IRS rules strictly. There's been a lot of abuse of this system, and as a consequence, the rules are fairly straightforward, but they are strict. A little bit of it's covered in your textbook, but if you really want to get involved with this, you really have to see a lawyer or a CPA, an enrolled agent, someone who is knowledgeable about it to much greater depth than we are in this course. Personally, I've never been involved with a private annuity, although I think it's a fantastic tool, especially if you have an older person who is in pretty bad health. And again, it's a lifetime annuity, so when the person dies, the children or grandchildren get the assets, and it's out of the estate. The disadvantage, I guess, really is that there's no security that the kids or grandkids will make the payments, and that becomes an issue, but it's certainly a very valuable tool to get out of the estate. A sale leaseback transaction, a sale of a business-related property to another. The leases the property back from the lessor. Again, this is very similar to the gift leaseback that we talked about in previous modules. Lessor gets the appreciated asset and gets the payments. Lessee gets the business expense on the lease payments and is removed from the lessee's estate. Again, the fair market value becomes an issue, and you have to be able to prove it's the fair market value. The depreciation for the lessor is going to be based on that value, and fortunately, they don't have to worry about the value that was depreciated before by the parent, as you would on a lease back arrangement, gift lease back arrangement. And again, it's very hard, as it was for the gift lease back, to justify the numbers. The number crunching many times did not give the best answers because of, well, the easiest way of putting it is the values involved, and the transaction does take a lot of responsibility to prove that it's a fair market value, which the IRS never accepts. Taxation sale of a gifted item, and this gets complicated. The donee's basis is the lower the donor's adjusted basis of the fair market value at the date of gift, and we mentioned that earlier in the course. If the basis is the adjusted basis of the donor, any gain or loss on sale of the fair market value, the sale less the adjusted basis, and that's kind of straightforward, I think. If the basis of the fair market value at the date of gift sales above the fair market value are gains, sales below the adjusted basis are losses, sales between the fair market value and adjusted basis are tax-free. Maybe easier to summarize it as follows. If I get an asset that's gifted to me, and it's my basis is going to be the lower fair market value or the donor's basis. Now, if its fair market value is the higher, that means that I get the donor's basis for my fair market value, and then anything that I sell above that basis is profit. Anything below that basis is a loss. Very logical. Now, the illogical part becomes if the fair market value is is less than the adjusted basis of the donor. So the donor's basis is 50,000, the fair market value is 25,000. In this case, we look at anything below the 25,000 is going to sell. If I sell it below 25,000, I have a loss. If I sell it above 50,000, I have a gain. And anything between the 25 and the 50,000, there's no tax ramification. And don't ask me to explain why that law is in effect. At that, we've covered the third module, and we're ready to go on to the fourth. We're going to get involved now in the taxation areas. So if you want to break it, I usually say modules 1, 2, and 3 are best to do together. But then you can do 4 and 5 separately. And with that, I'm going to say good luck, and I'll see you in the next